Welcome to It's the Economy. The dollar index has slid to a 6-week low overnight at 98.6 after President Trump threatened to raise tariffs on steel and aluminium to 50%. Now, US yields have been hugging that 4.5% mark for some time now, especially after the big, beautiful bill was passed by the US House. That bill threatens to raise the US deficit for the foreseeable future. The currency and yield markets actually all over the world have broken long-term patterns. Japanese yields now are ruling at the highest level since 2008, although, of course, today's auction received a little more bids. Yet, most of ex-Japan Asia, including India, are in a rate-cutting cycle. To understand more about global yields and currencies, I have with me two experts, Claudio Irigoyen, the head of macro research, global research at BofA, and Rahul Bajoria, again, head of global research at Bank of America. Thank you very much, gentlemen, for your time. Claudio, let me start with you. This yield market is giving us altogether new patterns. What do you think will be the impact of global flows as Japanese yields and US yields remain high?
Well, I think we are in the middle of two main themes that will drive US growth in particular, and will have implications for the rest of the world. The first one is obviously the evolution of trade negotiations that will impact many countries. As you know, we have the view that Trump administration wants to negotiate comprehensive country-specific packages involving trade, immigration, defense, and energy. By definition, those are negotiations that will differ from country to country. And tariffs are a tool that is expected to yield a lot of dividends. On the one hand, raising revenues, on the other hand, being a tool to negotiate better trade agreements, and also an incentive to bring back manufacturing jobs to the US. And the connection with the second theme is obviously the discussion of the fiscal bill in Congress in the US. And the reason why they are connected is because part of the discussion is how much tariff revenues you can collect, because that will determine the size of the fiscal deficit that will end up being the outcome of the negotiations in Congress in the US. I think the market is starting to pay more and more attention to that. We are seeing that in the way the long end of the yield curve is trading in the US. And as you mentioned, it's also important what's going on in Japan. Basically, we're in a situation in which fiscal policy has been very loose for many years in many countries, under the assumption that interest rates were going to remain low forever. Now we are in a different regime after the pandemic, and obviously the pressure on debt dynamics in many countries will be in crescendo, and we're going to see that in the way yields are going to remain trading in the near future.
Yeah, that's a big point. Most developed market governments, or at least two large ones, have been profligate with their fisc. But it's in contrast to the Asian or emerging markets, which were the old, spendthrifts, are now finding much more fiscal discipline than their own past. But Claudio, what will this mean to flow of funds into Indian bond markets? If the US bond yields are high, but the US currency is weaker, do you expect that we saw good flows into Indian bonds? Will that continue?
Well, I think what markets are trying to figure out is how to rebalance global portfolios now that they are not as in love with US assets. Before all this trade uncertainty started, global portfolios were massively overweight US assets, underweight emerging markets, and in particular Europe. And since then, we are observing a rebalancing towards more neutral positions. And that creates, to some extent, winners and losers. Markets are trying to figure out what are the more neutral countries in this trade war dynamics. And India could be one of the beneficiaries in that sense. So obviously, the size of the US market is so overwhelmingly big relative to the size of any other market that no single country or region can absorb those outflows from the US. And it's going to be spread out across many markets, but emerging markets will definitely benefit, in particular as the dollar continue weakening, and India could be one of the main beneficiaries, absolutely. That's something that we will continue seeing.
Okay. Well, let me get Rahul into the conversation. Rahul, the CNBC-TV18 poll indicated that a 25 bips rate cut on June 6th is a given. And there was only one person asking for a 50 bips rate cut. Otherwise, all respondents at 25. What's your sense of the terminal repo rate? Does it go to 5.5%, 5.25%, 5%? And also, what's your sense of the 10-year yield? Does it go below 6 this year?
Yeah, thanks, Latha. So, at this point, we are still comfortable maintaining 550 as the terminal rate for India, looking largely at the growth numbers. We are seeing some signs of stabilization on the growth side. It's not looking particularly exciting in the very near term, but, I think what we are likely to expect is that, profitability probably improves at the margin. We see a little bit of stabilization in high-frequency numbers already visible to a certain extent, and that probably lays the ground for the RBI to preserve some ammunition if and when growth slows down. I think there could be a case made for a lower terminal, but at this point in time, I think a lot of good news is already in the price as far as inflation is concerned, and so RBI probably will continue the easing cycle. We also expect a 25 basis point rate cut, but beyond 550, we think there might be a preference to kind of save some ammo in case it is needed to be deployed later on. On the bond side, again, we have had a very secular bond rally in India. We have seen the 10-year bonds come off by almost 75 basis points in the last 6 months. Our sense is that there's a little bit more juice left. We might flirt with 6% or below. But if there is a terminal rate of 550, then bond yields probably settle around 6%, give or take 10 basis points. But we will probably not see any further compression from there on. It also partly depends on how much capital flows and liquidity injections the RBI is willing to do further on. So we expect liquidity conditions to remain pretty flush. But then incrementally, again, it'll be a function of transmission is where we think the emphasis might come from Governor Malhotra in his Friday press conference.
Yes, of course, we'll watch out for that one. Claudio, what's your sense about the dollar rupee?
I think the currency will probably continue weakening. The dollar will continue weakening. I'm not necessarily on the camp of those that think that this is the beginning of the end of the dollar as the reserve currency of the world. I think that you will have to differentiate cyclical movements in the dollar from more structural ones. As I mentioned before this uncertainty and trade shock hit markets, global positions were massively overweight the U.S. under the idea that the U.S. was going to continue outperforming, running at potential or even above potential, and the dollar was going to remain the strongest currency in the world. What we are seeing now is part of that rebalancing. Obviously, the dollar needs to weaken, but when you think about the fiscal stance of many countries, as I mentioned before, not only the US, also Japan, Europe, a few emerging economies, UK, it's far from obvious that the dollar needs to weaken substantially versus other fiat currencies. I would
So what's your range, therefore?
The dollar and other fiat currencies should weaken versus gold.
So what, would the dollar index go to 90? 95, what's the direction and what's the extent? A ballpark.
The direction is of a weaker dollar. Maybe the dollar should weaken across the board another 5-7%. But again, it's going to remain extremely volatile because it's very, very dependent on the evolution of trade negotiations and the outcome of fiscal policy in the US.
So your sense is that gold's rally isn't over. This year, what do you expect? 3,500, 4,000?
Yeah, the gold will continue strengthening, and this is more a structural story. If you take a look at the evolution of global money supply over the last 20 years and the evolution of gold prices, you can see what's going on. You can see that fiat money, even the dollar, is weakening relative to gold, and that might continue. Obviously, it's not going to be a straight line. It's going to be bumpy, but the direction of travel, I think, is clear.
Okay. Rahul, what's your sense? I mean, a couple of questions actually, and not entirely related. Where do you see Indian growth this year after the higher than expected, but still modest 6.5% last year? And what's your sense of the dollar rupee?
Yeah, so on the growth cycle, we expect, broadly there to be a stability at, the lower levels of growth. I think it's important to keep in mind that, India's growth did slow down from averaging around 9% in the last 3 years to about 6.5% in the previous fiscal. This, we think, probably dips a little bit below to 6.3%, which is at the lower end of what the Ministry of Finance is forecasting, 6.3 to 6.8. And largely the downside comes from lower investment growth as uncertainty of trade policies, uncertainty of domestic fiscal spending, I think, does have an impact to a certain extent.
Yes.
But then monetary policy easing and then commodity prices will help. On the currency, we think, there's room for greater stability in the sense that we are likely to trade in a range, but that range is going to be a lot wider than what we have seen in the previous years. Governor Malhotra clearly has a policy of, being relatively more laissez-faire on FX. And, we think that 84 to 87 is a good range in which INR can move around. And then if we see capital flows make a big comeback later this year, then there could be scope for further appreciation in line with the weaker dollar.
Okay. Unfortunately, out of time, but thank you very much, Rahul and Claudio, for joining me in this conversation. And have a great conference out there. Whatever is left of it, I think you'll are wrapping up. Thank you very much for joining us. Well, we have to wrap up as well. On Bazaar, Chartbusters coming up.